Nobody will ever tell you chart patterns and other aspects of technical analysis on the real charts. You'll mostly encounter knowledge just copied from books. Explaining technical analysis through charts needs a lot of experience and highly accurate knowledge. Patterns on real charts are markedly different from schematics straightforwardly drawn on paper or computer. Today, I'm going to explain you so much about actual technical analysis that you may not have learned before. This way you will have a practical understanding which you can apply yourself. After this, you are going to trade like a real pro. Subscribe now to stay updated with all our latest videos and never miss out on any exciting content. Look here. Bitcoin's price skyrockets, hitting a peak on April 14, 2021 and another on November 10, 2021, soaring a massive 300% from its previous resistance at $17,000 on December 15, 2020. But why did it stop there? A closer look reveals the secret. Weaker volumes hinted to savvy investors to cash out, leading to what's known as a double top pattern. This is when the big players sell to lock in their profits, leaving newer traders scratching their heads. A double top pattern shows reversal in price movement. It suggests that stock's upward momentum has stalled and there is resistance at the previous high level. In fact, buyers are unable to push the price higher. Zoom in on that second peak and you'll spot a head and shoulders pattern forming. It's like a signal that investor interest is fading after a strong rally. The right shoulder and the neckline break are crucial indicators. Weak volumes on the shoulder suggest the rally can't sustain. Keep an eye on volumes in each rally. Large sell-offs with strong candles are a red flag. And don't be fooled by retests. Buyers often fail to push past the neckline. Remember, the bigger pattern takes precedence. In this case, the double top trumps the head and shoulders. Head and shoulder indicates a reversal in the price trend. It is formed by three peaks: a higher peak, the head, between two lower peaks, the shoulders. The pattern is considered complete when the price breaks below the neckline, which is a line drawn across the bottoms of the two shoulders. Now switch to the weekly chart and zoom out. You'll see Bitcoin's long-term behavior neatly laid out in a trending channel with clear support and resistance lines. Extreme highs and lows strongly follow this chart's support and resistance. With Bitcoin's bullish cycle underway, it's likely to aim for the high of the trending channel, reaching resistance levels as high as $200,000 to $300,000. Back to the daily chart of Bitcoin. Notice how it stayed above the 50-day moving average until it broke below, forming what's called a death cross. This is a strong bearish signal, especially when paired with other warnings like the double top we saw earlier. A stock isn't considered bullish until the price crosses above the 200-day moving average. A death cross occurs when 50-day moving average crosses below the 200-day moving average. This crossover is a warning that a significant downtrend may be underway. When a stock or cryptocurrency drops sharply, its previous resistance level often turns into a strong support level, as long as there are no underlying issues with its fundamentals. But there's a key difference to keep in mind. Take the example of the Luna coin's fall. Unlike other cases, Luna didn't find support at its historical levels because there were serious problems with its fundamentals. Now, here's a common mistake. Some people jump into falling stocks or coins, hoping they'll bounce back. But that's like trying to catch a falling knife. Patience is key. You've got to wait until it clearly reacts with the support and starts bouncing, showing signs of steady buying from big investors. When a stock starts falling, it takes breaks along the way, like a runner pausing for breath. These pauses show up as different patterns on charts, but beware of traps. Sometimes these patterns look like the stock is about to rise again, but they're just bull traps. So, when's the right time to jump in? Watch for the moment when a stock hits that support and starts to bounce up again, until price crosses above 200 MA and 50 MA crosses above 200 MA. We call this a golden cross. This is when big investors start buying in, and you'll see lots of big transactions happening. Institutions usually buy in before the public catches on, so watch out for their moves. Sometimes stocks recover slowly in a U-shape, and sometimes they shoot up quickly in a V-shape. It's important to keep an eye on the patterns forming around that support level. It could be a head and shoulders pattern, a double or triple bottom, or even a cup and handle pattern. Once a stock starts its upward journey, it tends to stay above its 50-day moving average and dips back to it several times before continuing up. These pullbacks are like mini buying opportunities, and as the stock climbs, keep an eye out for new patterns forming. For example, you might spot a cup and handle pattern emerging, signaling another potential rise. But remember, a pattern isn't confirmed until the stock breaks out of it with strong trading volume. The cup and handle pattern is a bullish continuation pattern. It consists of two main parts, the cup and the handle. The cup forms after an uptrend and resembles a rounded bottom, similar to a U shape. The handle is a smaller downward movement in the price following the cup formation. You don't have to memorize every pattern, but make sure you know 3 important points. 1. Which way the main trend is going. 2. Are there signs of trend continuation? 3. Are there signs of trend reversal? Take decisions only once breakout is confirmed.